Today we have two excellent panelists, very knowledgeable in the area of private markets and capital markets in general. And if you allow me, let me give a brief introduction to private markets, and that way we can make the most out of this discussion. So let me start with a brief definition of private markets so that we're all on the same page. By that, we're going to adopt the broadest definition of private markets, that is, investments that are not traded on public exchanges, so that we are all understanding what we're discussing here. And the types of asset classes that we're referring to is private equity, private credit, real assets like private real estate and infrastructure, and venture capital as well. And just to give you an idea of how important private markets have become, everybody knows after the financial crisis, interest rates were low, so there was a drive to find yield. And that propelled the growth of private markets tremendously. Today, by many calculations, and Sarah, you will be familiar with these numbers because they come from BlackRock's private market outlook, private markets are $13 trillion. Now, looking forward, which is where we're going with this panel, they are projected to grow to about 20 trillion by the end of the decade. That's massive growth in this area. And the question is, well, where is the growth coming from? Primarily wealth management. If you can believe it, only about 1 to 2% of individual investors have exposure to private markets today. And private credit and infrastructure. So just those two are expected to go from 20% of the share of private markets today to about 30% in 2030. Right? So massive growth in that area. And why is it that investors are encouraged to go to private markets? Well, the first one is that search for yield, very attractive risk-return trade-offs, obviously diversification, and it's an important driver of the overall economy, right? It supplies capital to important parts of the economy. However, there's some risk, and that's what we're going to talk as well in this panel in terms of liquidity. There's some opacity when it comes to valuations, right, as well as disclosure, and the new frontier, which is giving access to non-institutional investors. So with that out of the way, let's start with the questions. So Sarah, perhaps I can start with you. How do you see the role of private markets evolving over the next 5 to 10 years?
Well, thank you very much for the question, and thank you very much for having me here today. You know, as we look forward 5, 10-year type timeframes, we like to look at some of the what we call mega trends that are driving the systematic growth into some of these markets. I think, you know, when we look at these trends, one that comes immediately to mind is AI and technology, right? It's in every earnings report season after season, and I think that the build out into those to power AI transformation, we're coming up to very real constraints in terms of power, accessibility, and grid stability. And you know, those numbers around the infrastructure build and then the need for capital to fuel the AI transition, as well as the ancillary support that's needed in order to build these massive data centers. So for example, access to water, construction, equipment, all of these items need to be financed through CapEx. I think also another trend we look at is demographic shifts. So if you look across the developed worlds, populations are shrinking and changing in their complexion. And this really drives, again, that need for technology build out that we think is going to be a sustained force over time. You know, also geopolitical fragmentation, so rewiring of supply chains. Again, this is going to shift the way that infrastructure is built. We need to build more in different places, driving demand for capital. And then finally, if you think about businesses trying to operate in this accelerated time of change, the need for businesses to reinvest in CapEx is almost never ending, it sounds like, as you listen to these reports. And so clearly the demand for capital is very strong from these kind of capital consumers. And then the question becomes, where does that capital come from? And if you look globally, balance sheets are constrained. You know, typical providers of capital, banks, governments, they don't have enough to support this demand. And so it needs to come from other sources. And additionally, businesses are staying private for longer, and so that need to kind of finance growth is coming more from private capital providers. And then finally, I think that the need for long-term, clear line of sight into that capital in order to plan these longer trajectory projects is a nice demand for this private source of capital. So we think, these two forces are really conflating to create what we think is our high conviction view that the future for private credit or private markets is very bright indeed.
Excellent. Thank you, Sarah. Liz, would you like to complement that?
Yeah, thanks for having me here. I think this is a great topic for discussion. I would say that the growth trajectory and the demand equation is absolutely there. It is never ending, and with the reordering of the world, I mean, if you look at what Canada is doing as well in terms of building out, our own build in Canada and infrastructure, I mean, there are going to be a lot more opportunities. The question about where that capital is going to come from, I think I would say, if you look at the Canadian banks and foreign banks, infrastructure lending is something that we're actually pretty good at, and we do a lot of. So, that is certainly one pool that will be tapped. Then you've got institutional investors like the pension funds and institutional investors that would come in as well. So from a trajectory perspective, certainly from a Canadian perspective, again, if you look at the balance sheets of the big banks here, most of it is private assets, right? So we play a fairly significant role in today's economy, and will continue to do so for the future.
Excellent. Well, let's continue in this topic about future projections. So, Liz, let me continue with you. Do you think that there's going to be growing interest in this area, and what are the drivers of that interest, and how sustainable is this?
Sorry, in terms of the private?
In terms of the growth of private markets, and particularly, perhaps you can give us a Canadian view, what you're experiencing in capital markets.
Look, absolutely. So the sustainability, as I said, I think is being driven by some of the factors that Sarah, you just mentioned. I mean, there's more demand for data centers, et cetera. I mean, that's going to be global. Most of us in the banking system, we are also global players. We do this well. I mean, if you look at some of the activities we do in capital markets, we do infrastructure financing. We actually do what is known as NAV lending against, major assets, and we do this globally.
Right.
So, not to say that it is without risk, but it is something that is within our wheelhouse. And it's an important element of the growth strategy. I mean, how much can the banks play at? And part of that is driven by, as you said, balance sheet constraints, but also regulatory requirements. How much concentration risk we have on balance sheet, how much leverage can we put on the balance sheet. I mean, those are constraining factors. But it is an area that I would say, certainly from a bank perspective, we are firmly engaged in.
And maybe I could add from like an investor perspective, I spend a lot of time out talking to our clients. I think that reliance on sort of the 60-40 portfolio that has served many investors well over time is being questioned, right? So I think we did see some periods recently of correlation between equities and bonds that were perhaps unexpected. And so, not only does or can private assets create some diversification, but as they are becoming a greater pool of the available opportunity set, it would naturally sort of correlate that an investor may want to consider adding private assets in order to add that diversification back into their portfolio. And I think too, another theme I wanted to pick up on that you mentioned in your intro, the low interest rate environment certainly accelerated the growth, but I would say that ability to generate incremental and consistent income over time is also something that our investors are very much more focused on as public markets have become potentially more volatile that creates a nice ballast to the portfolio that you can get through private credit or real assets as well. And just finally, on real assets, that positive correlation to inflation is something else that's become more topical as the background has changed for our investors, and sort of that long-term positive correlation to inflation in the absence of RRBs in particular is certainly something that private assets can also deliver to a more diversified portfolio.
Absolutely. Biz, I think.
Yeah, no, I'll just add, I think the question really is, which pools of capital play where, right? So you just mentioned long-term assets. If you look at, CPPIB or others, I think if the numbers are right, 27 to 30% of their AUM is in private assets, I would say real assets. It's the long-term generation of cash, and you're matching up, your liability profile. Banks typically can't do that, right? So the question is, at what point in time do you play in these infrastructure projects or long-term asset plays? So there's a place for, I think, many participants, but I think that's the consideration. Where can you provide the greatest value? For example, if you're building something out from a construction perspective, that's not very conducive to a fund. A bank can do that better. There's a takeout financing that can be done, through possibly a fund or through institutional investors.
Very good and very important points. So let's talk a little bit about how these markets are interacting with the overall ecosystem. So how are private markets contributing to the resilience of the financial ecosystem? Sarah, perhaps we can start with you.
Yeah, and Biz, that was a perfect lead into this question, right? I think the ability for different investors to play along different types of risk where they're well suited, right? So to the extent that you have broader access to a more diversified base of capital providers supporting all these different types of projects, that leads to greater resiliency overall. And I think as well, private capital, whether it be from a bank or an institutional asset manager, that knowledge that you have capital available over longer periods of time, relationship-based lending, relationship-based support, strategic support in many cases, especially as we work on the equity side with our partners and strategic corporate partnerships as well. I think all these components really lead to a system that is more balanced and better able to support risk diversification across the economy, and then also support a more robust kind of growth trajectory for all the needs of capital.
Correct. Excellent. If I may ask a follow-up question on that, do you see like a shift going back a little bit in terms of sustainability, in terms of a move towards additional importance on relationship-based lending going forward, particularly as these markets grow?
I think, like all things in private markets, it's probably very idiosyncratic. So it's not a one-size-fits-all, and that's frankly one of the benefits of private capital, is being able to be tailored to the solution. So in many areas where we operate, the ability to deliver strategic support, operational support, network effects across our various companies that we interact with can be hugely beneficial to the growth trajectory of the businesses that we support. And in some cases, it might be a shorter-term need to kind of bridge something that is a little bit more transactional. So I would say it depends, but certainly I would say more broadly across private capital, having strong relationships, that sourcing engine is always important. So it depends on how you use relationships, but at the end of the day, this is a people business for sure.
Absolutely. Biz, what are your thoughts in terms of how private markets are contributing to the resilience of the financial ecosystem?
It's absolutely critical. I think I'll go back to the bank balance sheet. We lend across the spectrum. You've got, small business, upper-end commercial, national, large commercial, and some very large sort of multinationals who are also private. So we're playing in the full spectrum, and we're financing, wealthy retailers or wealthy individuals on a private basis so that they can make the economy tick. So it is absolutely critical, but I think the interesting point is you've got to have multiple players. It can't be, so if I can just make one observation, Canada, I would say, because of the dominance of the large banks, we have the relationships. If you look at the US market, it is far more fragmented. So you've got, you know, asset managers, you've got various sort of specialty lenders who fill a niche, all private, right? But it's multifaceted, whereas we tend to be less. So I think the role of banks, certainly, and multiple contributors to capital is a critical bit, and I think that's where we are at.
Excellent. So private markets also come with challenges, and I mentioned a few during the introduction. So Ms., what are you finding in terms of the challenges in these markets?
Maybe I'll respond two ways. So one, as a lender, as a bank and as a lender, and then, you know, I think obviously there's the question about access to high net worth individuals, et cetera. So on the banking side, I would say the issues are, you know, valuation. We look at sort of disruptions that happen from a policy perspective sometimes, which can have, you know, huge consequences for us. But I would say that, you know, the challenges on a private market, we're comfortable. We play in the economy. We know what it is. It is very diversified, and, you know, as long as we're not taking outsized bets, I think we're comfortable. If you flip it onto the investor side,
yes,
that's a different ballgame. I think their suitability, fit for purpose, understanding liquidity profile is critical. I think you're going to get into that a little bit more later on, but I would say the first part, you know, those challenges are overcome through diversification, making sure that, you know, we have sort of the right tools to be able to assess cash flows, asset values. I think we're comfortable there.
And that's maybe a nice lead into one of the challenges we hear from our investors, is really this diversification issue. And so especially in like private equity, but across other assets as well, this challenge of realizations in markets that have been volatile. So distributions have not lived up to the modeled expectations. And so as a result, if you're not getting capital back, it's difficult to reinvest. And one of the things we always recommend is vintage diversification. Correct. Being another source of risk distribution. And so if you're not getting that sort of velocity of cash flow, it's difficult to manage that diversification in a broader portfolio program.
Makes sense. So this shift to retail access, that's one of the frontiers right now in terms of creating liquidity for these markets and in terms of providing these opportunities to non-institutional investors. So Biz, what are you finding on the banking side? What are the implications of increased retail access in private markets?
So I'll address the wealth advisory side. So this is wealthy clients. They have a portfolio. They look at private assets and say, well, I'd like that in my portfolio. So we have advisory, and then you have discretionary. Where I think we have the biggest challenge is discretionary. So this is where the bank is making decisions, or the broker dealer is making decisions that I'll put your money into a private fund. And there, I think the biggest question is suitability and know your product. I think we talked about some of the issues. So, you know, time horizon. Is it for income or is it for growth? how comfortable is the investor with the valuation process, because we've had some exit shocks, right? So the NAV sits well, they want to get out, and whoops, you've got, you know, massive hit. So there are multiple factors. So I think it is here to stay. It is currently targeted towards high net worth, ultra high net worth, accredited and qualified investors. We deal a lot with family offices. We've dealt with it in terms of boxing in, you know, how much can be part of the overall portfolio. But it is something that is more and more topical. There are more questions are being asked. But do we have the right framework to say, you know, we can put you, you know, 60% into private assets? I don't think so. Not quite yet.
Anything to add, or from the institutional investor side as well?
Yeah, sure. I think, you know, I think across investor types, it really comes down to portfolio construction and, you know, managing a portfolio that's suited to purpose for your needs. And so I think this liquidity aspect is really important. So if you're trying to gain access to an illiquidity premia, and then you're wrapping it in something that's liquid, you fundamentally just change the risk-return profile. You know, that is just the fact. You know, I think illiquidity is a feature, not a bug, of private markets. And in order to kind of provide access to a broader group of investors, you know, we do think that democratization of access is something that, you know, can be very positive, but it needs to be done in a really thoughtful way. And I think the education around that and how it fits in your portfolio, you know, what the timeline to liquidity is, what the potential impacts to your portfolio could be in terms of valuation. I think one of the interesting components that we've seen kind of grow up with this increased need for kind of semi-liquidity is the maturation of secondaries markets. So certainly there's still an area, there's still a lot of runway there, but we are seeing kind of secondaries opportunities to create more kind of market clearing opportunities to solve for some of these issues. But I do think it's something that we need to be very cognizant of in the way that we're communicating these challenges to the end investor.
Yeah. I mean, the only thing I would add there is, yes, so if you look at some of the LP structures, you know, they'll trade in the secondary market. But again, I think it's a question of fit for purpose, because when you want to exit, that bid-offer spread could be extremely wide, which may be a shock. So all to say that we're making the right steps towards providing liquidity in different forms, but the investor needs to be aware of the risks. So it's not like trading Tesla.
That's fair. So let's dive a little bit deeper into some of the risk management considerations and client considerations in these markets. And Sarah, what do you think that are some of the key areas, some of the key risks that institutions and investors should consider as the exposure to these markets increase?
I think in conversations I've had with investors that are more familiar with public markets, two factors that they probably or often misunderstand are the importance of sourcing and structuring.
Right.
So these are non-standardized. So not everybody's looking at the same opportunity set on their screen and kind of picking a ticker and off we go. That ability to create your own opportunity set is a critical component to being successful in private markets, and there is broad dispersion across managers. I would say also in terms of structuring. So these are also non-standard investments themselves. So papering up these vehicles, the bespoke nature of the investments is one of the, again, I call it the complexity premia. It's another source of return, but it's also another source of potential opacity or difficulty in comparison. And so I think that recognition is helpful as you try to figure out, you know, how to compare and contrast different managers. So I think that's an area that, you know, we've certainly seen a buildup in a lot of technologies helping investors to source through sort of these underlying factor risks that can be very differentiated across managers that are under the same umbrella. And you mentioned, you know, Prequ and Aladdin, you know, we've certainly built lots of tools to support investors doing this, but it is not an insignificant challenge and opportunity to create, you know, a very differentiated portfolio. But something I think that investors are maybe less aware of if they're not coming with that kind of private markets hat.
Yeah. The only thing I would add there is in the private market space, the asset manager selection is critical because if you look at the performance delta between top quartile and consistently it'll be managers who have the ability, the scale,
right,
to perform. And again, it goes back to the question of if you go into the retail space, are they comfortable that, you know, someone else is managing their money for them? I mean, it's a bit of a blind trust. I mean, I don't expect a retail person to actually understand leverage or, you know, covenant-like structures or, you know, PIC structures. But how do you get yourself comfortable? And I think the asset manager selection becomes an important factor in getting that additional, I would say, lift. And that's a question we've been asked. So when we've had discussions with, you know, family offices or retail investors, the first thing they'll ask, and maybe that's the first thing they ask me, is, can I get the same thing in public markets, and what's my delta?
Right. So diving deeper into this area of risk, I have some questions from the audience that I will try to integrate here as well. So maybe we start with you, Biz, in terms of how are you managing liquidity and valuation risks that are two very important risks here? And what are some of the macroeconomic changes, for example, interest rates, inflation, that you see affecting this space?
I'll give you, again, two parts. As a bank lender, our stress testing is robust. I mean, we lend to hedge funds, we lend to infrastructure projects. It is done with our eyes wide open. Do we get into trouble from time to time? We do. So, but that's how it's done there. And then maybe Sarah can elaborate on that, but would we have an asset management arm as well, a fairly large one? So if you look at some of our funds there, liquidity, valuation are absolutely critical. I mean, if you look at sort of and we operate globally, so if you look at the FCA regime in the UK, we are subject to regulatory liquidity requirements on a fund basis. And that is rigorously done to make sure that we understand the risks for our clients. So I think it's a combination of the two. But I mean, this is a key area, and liquidity in particular is becoming much more of a critical issue for all investors, and particularly even in the fund space.
Yeah, and I would say that scenario analysis is a critical component to the way that we think about risk as well. You know, if you think about sort of the idiosyncratic nature of these underlying investments, the ability to kind of run it through a variety of scenarios, we think is a critical component to our risk framework as well. And I think also, in this respect, like, time is sort of your friend. So if you've been managing these types of portfolios pre-GFC, now we're kind of like ranking up more and more kind of stress events that we're able to run our portfolios through real time. So we think that's really helpful in terms of evolving the thinking around some of these aspects.
Let me follow up to that question. So what are some of the lessons that recent market stress events have taught both of you and your teams in terms of how to manage these markets?
Well, I think even if you just go back to, COVID, which
Right.
is further back than it feels like in many days, I think that ability to stay invested. So it goes back to managing your liquidity so that you have dry powder, so you can stay invested. You're not a forced seller. You can support long-term good businesses through troubled opportunities or troubled times. I mean, I think that has created a real opportunity. And so I think that's the number one thing, is make sure that you understand your risk of liquidity. You know where that liquidity is going to come from in a stress event, and you're prepared, and be ready to jump in and provide capital to good opportunities when you see them.
Any thoughts, Biz?
I'll say COVID was wonderful because we got pumped with liquidity that we didn't have to worry about, a lot of the problems. So COVID, I think, was a bit of a oddball case, but some of us who've been through the global financial crisis, when Lehman was going down and Bear Stearns, and including some of the businesses, conduit businesses that we were running here in Canada, we have sort of real horror stories. And you mentioned sort of SVB. SVB was hobbled because of liquidity. It was actually a combination of two factors. One, the fact that you could actually move money almost instantaneously by an app. It was like a drain in a second, and it was poor management of assets and liabilities. So that was a regulatory issue and a liquidity issue. Lessons learned from that is when we are lending, we look at liquidity profile of, of the entity very, very carefully. That's part of our stress testing DNA. So I would say, if anything, more often than not, I think it's liquidity. I mean, I think my takeaway, and I've got sort of Mark Hughes sitting over there. So I would say liquidity is the key ingredient, and we've learned our lessons along the way, and that's one key factor that'll cripple just about anyone.
Absolutely. So, Sarah, you talked a little bit about stress testing and embedding this in stress testing. And Biz, you also talk about some of the factors that are affecting how you do risk management. So perhaps, Biz, let's continue with that, and then we will go to Sarah for additional thoughts in terms of how do you think the profession in risk management is evolving? What are some of the new skills that you will suggest to people that are entering this space should have to manage these, the growth in these markets going forward?
So traditional markets, I mean, again, I would go back to understanding the, the stress, logic, how do we incorporate that? But that's valuation front, liquidity front. If I can sort of stretch the thinking a little bit more, anybody who is coming into the risk world today had better understand crypto, AI, and blockchain, and the unique risks that are sitting in that part. I mean, they're not new risks. It's just how it manifests itself and how you manage them that will become more important. And some of this actually spills into, private assets.
Absolutely. Sarah, anything to add to that?
I think that was a
excellent
solid answer.
There is let me circle back a little bit, and I'm trying to incorporate some of the questions that are coming from the audience as we move through these topics. But you mentioned a little bit in terms of the value proposition that is coming from these markets, particularly the illiquidity premium. So the question is, well, what is the source of this extra premium versus traditional corporate bonds or bank loans, and one company shop around?
I'm sorry, what was the second part of the question?
Won't companies shop around for?
Yeah. Absolutely. So I mean, I think some of the key kind of value proposition for private markets is speed and certainty of execution, right? So in a public market, bond issuance, there is some uncertainty into where that clears. You also have a dispersion of holders, right? So if you do come into a situation where you need some support from your lenders, for example, knowing who to go to is very helpful in terms of providing, access to additional liquidity as needed. So I think those are some unique aspects outside of just pricing that I think drive businesses to private lenders or private, equity managers as well. I think also, to an early point, businesses are staying private for longer for a variety of reasons. You see that, the average age of going to IPO has continued to extend. The average size of businesses continues to grow. And so if you look across the broader economy, the vast majority of SMEs are private businesses.
Right.
And so there is a huge need for capital that doesn't necessarily have the will nor the resources to go through a public process, nor necessarily wants those outcomes, right? It comes with a whole other regulatory element to it, reporting, expectations, and market volatility. So I think there's a lot of kind of fundamental reasons why sources of private capital can be preferred, where there is actual value that justifies the higher pricing, because for sure my cost of capital is higher than yours.
Liz, any thoughts on the value proposition in these markets and how they differ from some of the things that we might find, for example, in bond markets or other public markets?
No, I think, Sarah, you touched on it. It's, again, two dimensions. One, in the higher premium, that's your cash flow, so it's your income generation. Can you get a better return because of these factors, right? You're holding it for longer. You don't have the liquidity. You are taking you're relying on someone else to manage that process for you. Are you comfortable doing that? So I think you're getting that. And then if you're looking at growth, it's actually a much for the right institution, or I would say the right group of investors. It's stable. If you look at fundamental analysis, what you're doing is removing market noise.
Right.
Because sometimes the market is reacting to different factors that may not in any way, or I shouldn't say any way, but would not materially impact the fundamentals. So you remove that noise. So you can hold it for longer, provided that is fit for purpose.
Right.
So I think, these are things that we need to educate people on. What are you getting what are you giving up in return, and what you're getting?
And I think from that investor perspective, the ability to impact outcomes more directly, right? So actually create value and drive that value creation process is fundamentally differentiated than being a passive kind of public holder.
Right. For public, I use the Tesla. If you sell it, buy it at X and sell it at X plus Y, you've made money, right? But if you're doing private investments, infrastructure, or real assets, right, it's a bit of a different story.
It's a different game. Absolutely. So we have another very good question from the audience here. Is there interest in digital assets in the private market space, given the changes in regulation in the US and globally?
You're probably best positioned to answer that one.
That's a question for Biz, perhaps. What are your views?
So I think the train has left the station. It is going to happen. If you look at what has happened in the US with the 401k market, I don't know what the numbers are. It's probably about 12 trillion, if I'm not just the 401k in its entirety. So access is good. So you could argue that why would retail investors or others be excluded from the market? Right. If they have the risk appetite and if there's suitability, access should be there. And the US is saying, yes, you should. How and what the governance is around that, I think, is being worked through. If you look at Canada, there's, in Ontario, the OSC, we've got a term asset fund. I think in May of 2025, there's actually a launch pad which is asking for bespoke ways to provide access to retail investors. So there's a lot that is happening. And there's more that needs to come. But again, it's fundamentally making sure that investors, whether it's retail, high net worth, or institutional, know what they're getting into. And how do we make sure that we're able to sort of explain it?
Excellent. Sarah, we have a question for you. Do institutional investors have concerns with retail investors increasingly entering private markets? I will add my part concerns, so perhaps you see opportunities there. And how do you address these concerns and opportunities?
So I can't say that I've heard that feedback broadly, to be honest. I think where concerns can sometimes manifest is more in the wrappers, right? So some of these liquidity drivers, if you have retail investors looking to source capital from a retail wrapped portfolio, what does that do to the institutional investor's ability to either add or subtract capital? So it's more the flow dynamics, I think, that are interesting to institutional investors. I would say the vast number of our institutional investors still invest in either closed-end funds or separately managed accounts if they need an open-ended structure. And so the co-location of assets alongside retail is not something that we've seen proliferate across our platform. Now, that being said, smaller institutions, foundations, for example, that are looking for that consistent source of income are increasingly becoming interested in these semi-liquid structures. And I think that is potentially a very powerful access point for some institutional investors. Again, as long as they understand, what that potential profile looks like in terms of their ability to access liquidity on an ongoing basis. So again, just because you have a liquidity wrapper, there are always conditions that you need to be aware of in terms of how that impacts your risk return and actual ability to source that.
Liz, any concerns with retail investors entering the mix?
No, I think it's a positive, again, provided they know what they're getting into. So I can give you a few examples of some feeder funds. Retail investors know, but these were targeted towards accredited high net worth investors. Where I would have a concern is because these are done through feeder funds, you have the potential of being crowded out, the retail investor. So if you have sort of redemptions that happen on a monthly, quarterly, or on a gated basis, invariably the retail investor will be trumped by an institutional investor who will hold a lot more. So that is a risk that needs to be highlighted, but giving them access, I think, is a good thing. I mean, I think the whole idea is, one part is the risk, the disclosure, is it fit for purpose, are you suitable? The second one is, do you give access? And I think a lot of the things that are happening in the US is geared towards access to all.
Absolutely. And on that note, Sarah, how do you think that institutional investors can improve risk transparency in this area of private markets?
So I think the toolkit is just going to be critically important here in terms of understanding your sources of risk. And we've been talking about greater proportions of portfolios, whether it be institutional or retail, driving towards these types of assets. It's going to be increasingly important to really understand what that does to your overall risk profile, as the impact of these factor exposures are going to have proportionally more impact on your overall wealth experience. So I think the ability to kind of communicate through those, data points, frankly, is going to be just increasingly important as this becomes a wider kind of consideration for investors.
Absolutely. And one of the questions that we have here that I think is very interesting is, well, one of the concerns these days is a potential for what the member of the audience called double leverage, in the sense that there is this system in which the underlying asset is being financed, and then the cash flow coming from that underlying asset is used to pay the financing, essentially. What are your thoughts on that? Do you see any risk on that? How is this risk being managed? Maybe we can start with Biz.
So if I understand that correctly, you're saying there is a fund with leverage, and then you're giving more leverage to that? Yeah, we keep an eye on that. Again, some of the funds that we have, they actually restrict leverage, right? So whether it's BlackRock or we have our asset management arm, I mean, there are very strict limitations as to how much leverage you can put. It's not on open-ended. So that's on the investor side. And on the lending side, where we're lending to hedge funds, that we monitor very carefully. I mean, we actually, when we're lending against hedge funds, I mean, we right. Assess those very carefully, and it's also part of our stress testing in terms of what could go wrong. And we have limits and constraints around that.
I think it goes to diversification again, right? So let's just take a private credit fund, because that's probably the simplest, way to kind of frame this out. Each of your loans is by definition leverage to a business. Correct. And the drivers of each of those businesses, if you constructed your portfolio well, should have diversification around some of what those risk profiles look like. When you're putting leverage then across the top of your portfolio, not only are you being very mindful, obviously, of that quantum, but also the source of that leverage. So diversifying your leverage providers then across the top as well, and diversifying that risk. So I think yes, and also managing that is always going to be the critical component.
Excellent. Well, thank you very much to both of you. Excellent panelists. We could keep talking about this for another hour, but thank you, and I guess a round of applause for both of you.